today we've got Paul Moore from PM Capital. Paul, you're chairman of PM Capital. Can you first tell us, how long have you been in the financial services industry?
About 25 years. Yeah, first started back in 1985, 86.
Okay, and who was that with?
Bankers Trust. Yeah,
Okay.
First job straight out of university. So working with their superannuation group, analysing industrial stocks in Australia.
Right, okay. Look, when we look at the world at the moment, markets have had a big recovery. There's still a bit of an overhang in certain parts of the world, clearly from the GFC and things. What is your current major theme that you think for investors?
Well, I think the biggest and simplest theme is get your money offshore. Very simplistically, if you look at the Australian-New Zealand market, 40% of the market is dominated by banks, which are at historic valuation highs. 30% by resources, which in my view, the China story has played out. We're now in a bear market in commodities. There'll be trading rallies up and down, but it's not the place for long-term capital. So there's not a lot of opportunities left in Australia and New Zealand. And the New Zealand currency, as you know, is at an all-time high basically against most currencies. So it's one of those 1 in 10, 15, maybe 20-year events that you've got the opportunity to invest at very favourable exchange rates, and you just get a better opportunity subset overseas.
When you look at that, and you look at what you might invest in overseas, and clearly you at the sort of thing PM Capital invest in, you're looking at large stocks. What sort of outperformance do you think you can expect by investing offshore?
Look, it's always hard. I don't like predicting future return profiles because we don't know what the market's going to throw up. So all we try and do is find the mispriced opportunities, back our judgment with a lot of capital over a longer period of time, and the return profiles will be what they be. But if you think about it, the last 10 or 15 years, my guess is if we go back to the bottom of the currency, to the peak, it's probably knocked 3, 4, 5% per annum off offshore returns. So if we now look forward where the currency is probably in an emerging downtrend, my guess is you're going to get 3, 4, 5% per annum help from the currency. And bottom line from the equities, I still think you can earn high single digit to maybe low double digit returns over the right time frame. So you put the two in combination, and I think getting that 10 or 11 or 12% return on an annualised basis is not out of the realms of possibility.
Clearly that's a good return over a long period of time.
Very
so
good. Yeah.
What are the key things you look for before you invest?
I guess we're looking for opportunities that meet our criteria. And what I mean by that is basically we want to beat cash. We want to beat bonds, the so-called low-risk investment, although at the moment I would call that a high-risk investment. So if we can kind of foresee an environment where we can get 10% per annum out of a stock, so that's, if we're looking at over 3 to 5 years, it translates to sort of 35, 40, 45% as a sort of capital growth in a stock. That's ultimately what we're looking for. Now again, depending on what the markets throw up, you just don't, sometimes it can be better, sometimes it can be harder to achieve that. But that's kind of a rough rule of thumb. If I can get a sort of a 10% return over a long period of time, you'd be surprised on a compound basis what it adds up to.
Sure. You mentioned there in passing there that you thought that bonds were actually a high risk strategy right at the moment. Would you like to elaborate a little bit on that?
I'm not only say high risk, I'd say just run as fast as you can. I wouldn't touch a bond as everyone was paid to do so. Bottom line is interest rates have been in a 30-year bull market. It's hard to believe, but you go back into the 70s and US bonds were selling at 17, 18%. They've recently been selling at 2 to 3%, and it's just lower inflationary environment, and it's been topped off, as you do at the top of all bull markets, by an extreme event, and that is the Fed buying 75% of the bonds available. Once they step out of the way, you have to return to normal demand-supply balance. Bond rates will back up. Who knows where they'll go? But I don't want to buy any asset that's been in a 30-year bull market. So if you think about it, 2 and 3%, locking in a 2 or 3% return, it's like, why would you bother? If we can't find better than that in equities, then it's time to hang up the boots. But bonds are very risky.
It's interesting, isn't it? You're saying bonds are very risky, yet I would say to you that people have got money in bonds because they see it as low risk, and that brings me to my next question, which is volatility. And you know, we look at the VIX index and that, and when the things were really strong, all that does is it creates fear amongst a lot of retail type investors. You want to make a comment about what the reality of that is and the opportunities that may throw up?
Look, the reality of the investment world is that the way you make money is by taking advantage of fear, because everyone's running in one direction, and that's when you find great opportunities. And so just have a look back at 2009, the peak of the fear. That was the best time to invest in equity markets. So if there's no fear around, you don't want to be invested in equities. And that's why medium to longer term, we still think there's good opportunities, because there's definitely, in the back of people's minds, they're still fearful. And if you look at bonds, I mean, bonds today are like the TMT stocks were in 2000. Huge extreme, very, very dangerous from an investment point of view. The reason people are there is because it's an asset that's done well for them historically, but it's played out. If they go from 2 to 1, you hardly make any extra money. If they go from 2 to 4, you lose a lot of money. So, yeah, I'd be, as I say, we don't own any bonds, and we're actually short some bond proxies in our equity funds. I wouldn't go anywhere near them. It's anything but risk-free. Moving back to equities,
we'll leave bonds for a minute and move back to equities. Commodities, obviously there's been a huge run-up. We've certainly seen the top in the short term anyway. What's your view of where the current commodity cycle is?
Early stages of a bear market, and again, we were buying BHP and Rio back in 2001, 2002 on the proposition that no miners were spending any money, so there was no new supply. Commodity prices were in their lower quartile of historic range. And back then we said, when do we sell? We'll sell when all the mining companies are spending all their cash flow on capital expenditure, because that means supply is starting to catch up. 2 years ago, capital expenditure went to an all-time high, and guess what? Commodity prices have been coming down ever since. We still think we're in the early stages. It's like TMT back in 2000. You had the original crack, then the big cap stocks ran back, and then they went into their real bear market. So most commodities have already corrected 50%. In fact, aluminium's gone to a new low recently. Iron ore is still holding up because steel demand's still strong in China, but it's always been the lagged commodity. And now oil's starting to come down. So it's actually playing out exactly as all previous commodity cycles. The only difference is the boom was so much bigger this time because of China. Guess what? That means the bust will ultimately be even bigger.
Well, from a New Zealand perspective, here's hoping soft commodities keep up. Let's moving away from commodities for a second. Aussie banks, they look fairly fully priced, would you say?
Very fully priced. The story, high payout ratios, sustainable dividends, reinforced by lower interest rates. Basically, that story's played out. Banks in Australia, no matter what financial valuation metric you look at, are selling at their top 10% over the last 20 years. So there's not much left in it. I don't see any great danger in it, but I just don't see any upside, and that's usually a time to kind of take your money away and look elsewhere. And again, if interest rates start backing up, guess what? That'll impact the way people price the dividends, and the stock price valuation will start to come down.
So you're saying that now. I'm aware that when you look around the world, that the Aussie banks are selling on pretty high multiples compared with some of the other banks around the world. Does that mean that the Aussie banks are better, or do you see that there's a mispricing between the two at the moment?
Definitely a mispricing. Again, it's that rush to safety, or people's perception of safety. They think banks will never do them wrong. But if you look at a simple example, Wells Fargo in the US versus CBA in Australia, they're very comparable banks. Our fundamental work will actually tell us that similar credit risk, Wells actually has a better deposit franchises. They're half the gearing, they're more profitable on a return on assets, and yet Wells sells at 10 to 11 times, CBA sells at 15 times. And that highlights the arbitrage between domestic banks and offshore banks. So Bottom line is they are fairly similar, but one's selling 30% higher than the other. So with the currency at an all-time high, to me it's almost a no-brainer. Take from one and reinvest it in the other.
Obviously, there's been, as I said before, a recovery around the world, and governments all around the world, and central banks have really underwritten that. They've put their hand in their pocket and pulled out quite a lot of cash. And the Fed have been they've certainly led the way. So, what actions do you see that the Fed have done that affects Australia and New Zealand, and what are the effects on the Fed's actions around currency?
Well, the biggest impact that the Fed has, as you say, excess liquidity which is not being used by the economy, so it flows into financial assets. And it flows into what people perceive as the safer assets at the current time. So Australian dollar, New Zealand dollar, there's no doubt in my mind that they're being impacted by the Fed. I would argue if the Fed had already begun to taper, that the currency would already be at 80 cents. It's just waiting for the Fed to taper, and then it'll start to emerge into its downtrend. So, when the Fed normalises, US rates go up, US dollar is a better bet. The peripheral currencies usually get hit. You're also starting to see a little bit of it in the property markets. Not 100% sure on New Zealand, but definitely in Australia, you're starting to see it bubble away again because borrowing costs are so low. That's not good for the economy. That's non-productive. The reality is the Fed, hopefully will start to taper soon, return to normal, get out of the way, and let real businesses start to spend all that cash that's on their balance sheet.
You mentioned cash on balance sheets. We've seen another number of companies starting to give back a lot of that cash, and there's been a lot of pressure on a number of companies right through to Apple. Mm-hmm. So your comments on that, and do you see that pressure continuing? Do you see them continuing to give cash back?
Oh, they'll definitely continue to do it because of shareholder pressure. And remember, in the US, it's kind of coming from an extreme of very low payout ratios to get to more normal payout ratios. But it does mean that you've actually got a lot of companies over there that are now earning dividend yields equal to or greater than the bond rate. So you're already getting a free start on the bonds. But to be honest, I think what the markets want, in an environment where there's not a lot of true underlying growth going, they say give us the cash back. But one of the reasons the market wants the Fed to get out of the way is because they'd rather have the businesses start to invest that capital, grow their business, employ more people, and that's when you get genuine earnings growth. And that's what the market will actually re-rate going forward. So yes, there's pressure on in this current environment to maximise the payout, but I think the market would actually prefer that they were spending it on their underlying business.
Okay. Been quite a lot of publicity on the improving US economy, and particularly we're starting to see a return in housing. And statistics I've seen that show that, look, yes, it has improved, but it's still, compared with normal, still quite a long way to go. Your comment?
Yeah. Basically, the US housing market, the simplest way to describe it is we're at the end of the first innings of a baseball game, and there's another 8 innings to go. It was the greatest bust you've ever seen. House prices were down 50-60% in the peripheral markets. So when you're down that far, you can be up 20 or 30% in a year and still be down 50% from the previous peak. So housing finance in the US is still difficult to get. So there's a lot of impediments from the market reacting normally. And the reality is, until all those issues are rectified, you're not going to get even a normally operating market, let alone a bubbly one. So my expectation is that this market recovery in terms of housing prices will probably play out over a minimum of 10 years. It's going to be a slow 2 steps forward, 1 step back. So our attitude is every time it steps back, we're going to take advantage of it.
And look, finally, in New Zealand, I think we've got some $120-something billion, which is a lot in New Zealand terms, sitting in banks on cash deposits. So that's cash. So we've got cash, and we talked about bonds, and we're not fans of that. But have you got a comment on that versus business? And because I'd love to see more of that money into productive assets, because that does help to grow our overall economy. But have you got any statistics on what cash and bonds might have done versus business?
Well, I mean, if you look at the return a business owner is getting pre-tax, across a range of businesses. It probably ranges from the high single digits to the low double digits. So for example, a Heineken brewing, slow growth business, but great brand, it's probably giving a business owner an 8 or 9% pre-tax return versus whatever your cash rate of return is. So that's a pretty decent margin, and guess what? The business grows slowly over time, whereas the cash rate won't. A Wells Fargo that we mentioned is giving a low double digits, sort of 12-13% return. So again, a very significant premium. Even if you allow for a backup in interest rates, there's still a significant premium. So the odds are very much stacked in favour of owning a business rather than owning cash and bonds. And let's face it, the only reality those cash numbers are so high is because people are running from the fear of the GFC. But again, they're looking backwards, because when all those cash deposits went into the banking system, 09, 10, 11, guess what? That was actually the best time to be buying equities. So the markets are a bit ahead of themselves short term, but I think longer term, that underlying return that a business owner is still getting suggests you'd much rather own a business than own cash. And to me, the smart investors will get ahead of the curve. Don't look backward. Look at the environment for the next 3 to 5 years, not the past 3 to 5 years. And that to me says people are still way over invested in term deposits.
Thank you, Paul. That's most insightful. Thank you very much, Paul Moore from PM Capital.
Thank you.
Thank you.